Strike levels, delta and IV for options trading. Step 1. Analyze strike levels. 1. Identify key strike prices. Look at out-of-the-money, OTM, and in-the-money, ITM, strikes. Pay attention to round numbers or congestion areas on the options chain. Focus on strikes near the current stock price and high open interest levels for liquidity. 2. Determine market sentiment. If the strike price with the highest open interest is near the current price, this indicates significant market interest around that level. Look for the max pain point, highest open interest on both calls and puts, as a potential target for price movement. 3. Look for strike level clusters. Clusters of open interest around specific levels may suggest potential price targets. Watch for major round numbers, e.g. 100, 150, 200 strikes, that have psychological significance. Step 2. Analyze delta. 1. Delta calculation. Delta measures the sensitivity of an option's price to the movement of the underlying asset. It indicates how much the price of the option will change if the stock moves by $1. Long call. Delta, positive and increases as the option moves deeper in the money. Long put. Delta, negative and increases in magnitude as the option moves deeper in the money. 2. Trade setup. Based on delta, for a bullish strategy, you may prefer higher delta calls, delta 0.50, as they will closely track the underlying price movement. For a bearish strategy, consider higher delta puts, delta 0.50, for the same reason. Delta neutral strategies, e.g. straddle or strangle, involve using options with similar magnitudes of delta to offset each other. 3. Entry strategy. Breakout trade. If the delta on an ITM call is high, e.g. 0.70, 0.85, and the underlying stock is nearing a breakout point, a resistance level, consider entering a long call. Reversal trade. If the delta on a put is increasing as the stock falls, and you identify a key support level, you might enter a long put. Step 3. Analyze implied volatility, IV. 1. IV. Calculation. Implied volatility, IV, is a forecast of a security's volatility, derived from the price of its options. High IV means the market expects high price movements, and low IV indicates expectations of stability. Relative IV. Compare the current IV to historical averages. If IV is higher than average, option premiums will be more expensive, and vice versa. 2. How to use IV. High IV. If IV is high, options are expensive. Use strategies like selling options, e.g. credit spreads, or iron condors to capitalize on overvalued premiums. Low IV. If IV is low, options are cheap. Consider buying options to profit from potential price movements when IV increases. 3. Entry strategy. Based on IV, high IV. Entry. If you're expecting a range-bound market, consider selling options or using iron condors when IV is high. Low IV entry. If IV is low and the market shows signs of volatility, consider buying options, calls, or puts as a longer-term play. Step 4. Combine strike levels, delta, and IV. Example setup for bullish entry. Strike level. Choose a strike price near current market price with high open interest. Delta. Select an ITM call option with a delta of 0.60 to 0.70. IV. Ensure IV is low or moderate. This keeps the premium within reason but still leaves room for upward volatility. Example setup for bearish entry. Strike level. Choose a strike with high open interest on puts. Delta. Select an ITM put with a delta of minus 0.60 or lower. IV. Watch for high IV and consider selling premium to capture the inflated prices. Step 5. Entry models based on technical analysis. 1. Breakout model. Entry. As the stock breaks above a resistance level, or below a support level, buy an option, call or put, at a delta of 0.60 plus. Target. Take profit when the stock moves towards the next resistance charge support level, or when the delta of the option increases substantially, indicating in the money status. 2. Reversal model. Entry. Enter a put when the stock shows signs of reversal at a resistance level, or enter a call at support. Delta consideration. Use a delta of 0.50 or lower for a put when the price action begins to break below key support. 3. Range-bound model. Entry. Buy a straddle or strangle when you expect significant volatility, but are unsure of direction. Buy options when IV is low and you anticipate an IV increase. Target. Exit when price moves significantly away from the entry point, preferably before the options expire. Final thought: strike level. Always choose options that are closely related to your analysis of the underlying stock's price movement. Delta. Understand that high delta means a closer relationship to the stock's movement. Low delta means you're giving the stock more room to fluctuate. IV. Always consider how expensive or cheap options are in relation to implied volatility. The more volatile the market, the more expensive the options. Use technicals. Always support your option strategies with technical analysis, e.g., trend lines, support or resistance levels, candlestick patterns, to increase your chances of success. By focusing on these factors, you can build a strategy that aligns with both short-term and long-term goals.